Every year, the tax laws change a little bit, and most notably, it's usually cost of living type adjustments. So last year, the standard deduction was $12,000. This year, it's $12,400, and other things like that change. So they modify it to keep up with inflation. So there's lots of minor changes every year, but every now and then we get a major change. Uh, I remember the 1986. This is what I learned when I was in college, way back when. We talked about the 1986 tax laws because it was only about 10 years old when I went to college, and it made major changes. So I remember in college we studied how it was before the 86 Tax Act and after the 86 Tax Act. Well, now we have the TCJA, which is another major tax overhaul. Some other minor things. Bush Jr. eliminated the marriage penalty by making married filing joint double the single deduction. So before, if you had two individuals earning the same amount of income, they would pay less tax than two married people paying the same, earning the same amount of income. So you had this penalty for filing joint. And that created a lot of married filing separate returns, and it just unfairly penalized married people. And so they did away with that. So that was a pretty good one. And then with the TCJA, there was a lot of benefits for it. They doubled the standard child tax credit from $1,000 to $2,000. So for every child on your tax return who is under 17 years old, you got a $2,000 tax credit. And remember, tax credit is the good one. Tax deduction's not as good. It doubled standard deductions. We went from $6,000 for a single person to $12,000 for a single person. And we went from $12,000 for married filing joint to $24,000. So now you're able to earn more money tax-free. And it eliminated the personal exemptions. You used to get a tax deduction for every person on your tax return, and it was right around $4,000 when they phased it out. And so this was a pretty big one because, you know, a married couple with two children, let's say, they would have had about $16,000 of personal exemptions that they could deduct. But since that went away, they would no longer get it. So that's why the child tax credit doubled. So now for their two children, they would get $4,000 tax credit, which is way better than the tax deduction for the exemptions. So they kind of give and take a little bit here. They reduce the tax rates. You probably hear people talk about tax brackets and all that all the time. We're a tiered income system. So that means your first, like say $10,000 is generally tax-free, but then after that, you start paying a little bit more income tax rate. And as you earn more money, your tax rate goes up and up and up. But it's not on all of your income, just on the amount of income that exceeds the tier that you just broke. And we'll learn more about that later on. And it eliminated certain deductions. One of the big one was entertainment for corporations. So corporations used to get a pretty significant deduction for taking clients to, ball games or on fancy ski trips and whatnot. And they did away with that. And that was a huge one. And then unreimbursed employee expenses. So this is where you're an employee working for somebody. You used to be able to deduct expenses that you spent to help you earn that income. And I call it Becky here because she's one of the prime examples. Becky earns a significant salary being a salesperson for a food distributor. But as part of her contract, she has to pay for all of her own expenses, like her car. She does a lot of driving around because she drives to restaurants from Dallas to Durant and everywhere. So she's always going to all these restaurants, and she has to pay for her own car, her own gas, her own repairs, tires, all that good stuff. As part of, salespeople do, they like to schmooze their clients. So she'll take people to dinner. She'll take them out on, trips to hockey games and whatnot. And now she used to get a deduction for that where she had a significant salary. She would have a very large deduction. Sometimes 1/3 of her income was a deduction for what we called unreimbursed employee expenses. But now she doesn't get to take that because they've done away with that deduction. So now she spends all this money and she doesn't get any benefit for it, but she still has to pay tax on 100% of her W-2 wages. And so that really hurt. So let's look at some examples of this before the TCJA, and I believe this stands for Tax Cut and Jobs Act. So George and Martha and their two kids, this is before the tax cut. So you can see they had gross income of 100,000. They would have got a $12,000 standard deduction and a $16,000 for personal exemptions. And we got that $4,000 per person on the tax return. So we have 2 kids and then George and Martha. So that's $16,000. So they would have had $72,000 of taxable income. We're going to estimate their tax at 15%, less the child tax credit. We're assuming both their kids were under 17, so they got $1,000 each. And so they would have owed $8,800. By looking at it now after the TCJA, we still have $100,000 of income. Our standard deduction is $24,000. And this year for 2020, it's like $24,400. We don't get a personal exemption anymore because the TCJA did away with that. So we have more taxable income. You see here we had $72,000. Now we got $76,000 of taxable income. I didn't worry about the tax break. They did drop the tax rate. So this really would be a little lower, but I was trying to make life simple because I'm lazy. And so their tax would have been $11,400. So now you're thinking, well, they didn't save any money. They're actually paying more in taxes. But since the child tax credit went up to $2,000 per child, they qualified for $4,000 of tax credit. So now their tax due is $7,400. So you can see this saved them money by having the increased child tax credit. And really it'd be even a little higher because they probably would pay about 12% instead of 15%. So the TCJA really helped out a lot of people with the doubling of the child tax credits. Now, if you don't have children, did you still benefit? Well, let's take a look at it. So now we're going to do the same thing, $100,000, $12,000 standard, but now we only have 8,000 of the personal exemptions, 2 of them, George and Martha. And so we multiply that by an estimated 15%, $12,000 is what their tax would have been. But by looking at it now, after the TCJA, now we have the $100,000, but we have a $24,000 standard deduction. So that gives us $76,000 of taxable income. Multiply that by 15%. And again, I think it would really be closer to 12%. And you can see we saved $600 even without qualifying for the child tax credit. So pretty good overall. All right, so that wraps up our review of the tax history. You know, the main thing I want you to know is we haven't always had income taxes. We enabled the 16th Amendment to allow Congress to levy taxes. There's 2 reasons for the tax laws, the economic and the social things. Economic, to raise money for our country, which we do a really bad job at doing. Well, we raise money pretty good, but we spend it even better. So that's the economic thing. And then to get businesses to do things like hire certain people or buy equipment. And then social reasons, get people to do certain things, adopt children, give to charities, things of that nature. So in our next lesson, we're going to look at reporting entities and talk about all the fun that comes with that.